Hi, my name is Cody Novak, Portfolio Manager with Novak Private Wealth Counsel. And today, Tom Kennedy from Kensington Private Equity Fund that we've recently added to the portfolio has come in and joined us, and he's going to share a little bit of information about their particular fund. Thanks for joining us, Tom.
Thanks, Cody.
Now, Tom, could you give our clients just a very high-level overview of what the Kensington Private Equity Fund does?
And Cody, we're a broadly diversified pool of investments in private equity in predominantly North America. It's about 2/3 in Canada and about 1/3 in the United States. Underpinning the fund is investments in roughly 250 companies in all different industries.
Okay.
So it's a very widely diversified pool invested in a lot of different companies.
Okay. And then what makes investing in private equity different from public equity, which most people are most common with, like a company like McDonald's or a company like Nike, buying them on a public stock exchange versus investing in a private company like you do?
Okay. Well, I own Nike shares,
Okay.
and I've never had a phone call from management. I get the reports, I follow them online, and I can either buy or sell the shares, but I can't control the investment. Private companies that we own, I see their financial statements every Friday on my desk. We have very tight control. We decide when we want to grow, when we want to sell, if we want to build a new plant or offer a new service. That's a decision that we make together with the management team. So I would say it's much tighter governance, much tighter control, and therefore the ability to grow it at a pace that you think the company's management can handle.
Okay, great. And then what is the main benefit to our clients who may own 3% of your fund along with a number of other different investments? What's the benefit to our clients of owning adding you to our portfolio?
I think there's two real differences. One is it's a diversifier. If you own public securities of any sort, you're limited to those public securities. And as we all know, public markets can get overbought and oversold. So there's volatility in the public markets that does not exist in the private markets. And most companies that are public tend to be bigger businesses. We offer a diversifier from that, in that the private market is much bigger than the public market. There's more companies, there's much more business done in the private market than in the public market. So you get access to all of those management teams, all of those business opportunities, and the related growth. Over a long period of time, you should be able to generate considerably better returns in the private market than you do in the public market. And that's been proven for 4 or 5 decades. So I think it's an enhancer to your returns if you're doing the public-private mix properly.
Yeah.
And it's a diversifier and a stabilizer in your portfolio.
Okay, perfect. Yeah, that's great news and exactly what we're looking to achieve by adding the private equity fund to our clients' portfolios. And then lastly, what would be a risk in investing in a private equity fund?
The private market is not immune to recessions.
Okay.
Businesses rise and fall with the economy, and private businesses are no different than public businesses. The valuation of a private company doesn't go up as far or down as low as a public company, because
Okay.
there isn't the psychology of public markets involved. I think the biggest risk is if the people managing the investment, so in this case Kensington, makes a mistake on the judgment of management and doesn't correct that mistake. One of the biggest problems we've had over the years is where we've not acted fast enough to make changes in management where they're just not doing their job.
Okay.
We've learned that lesson, and we are very careful about the selection of management, but I think that's the biggest risk.
All right. And you were mentioning some figures of how many companies you've invested in throughout your career and where the losses came from. Could you share some of those figures?
Kensington's a 23-year-old company. We've been doing this for a long time. And in that 23 years, we've invested in over 1,000 different businesses. We've lost all of our money on 4 of those investments, and we've lost some of our money on an additional 6. So 10 out of well over 1,000 have been unsatisfactory performers.
Okay.
Sometimes you don't make great returns, but our returns over that period of time have certainly been in the mid-double-digit range, and we're pleased with at the mid-teens range. We're pleased with that.
Yeah.
That's net to investors, and I think as I said, if over the long term, your private equity portfolio should be able to outperform your public equity portfolio by 300, 400, 500 basis points. And if you're achieving that, then it's doing its job inside your portfolio.
Absolutely, yeah. Okay, well, thanks so much for sharing some time with us, sharing some of your wisdom with our office and our clients. If you have any other questions or you want any further information on Kensington, reach out to us and we'll provide everything that you need. Thanks.
Thank you, Cody.
Lastly, we just want to show you the performance that the Kensington Private Equity Fund has had since its inception in 2010. In the 2 right-hand columns, you'll see KPEF, that's the Kensington Private Equity Fund, and all its annual returns are listed below that. To the right is the S&P TSX, and that is the benchmark for this fund, and all the benchmark returns are listed in that column. So you'll see for 2018, so far this year, the Kensington Private Equity Fund is up 17.8%, and the TSX, our Canadian index, is down 5%, as you may already know. Feel free to press pause at this point and look over the performance history in more detail. But thank you very much for tuning in, and we look forward to the continued success of the Kensington Private Equity Fund as part of your portfolio.